Okay, I think the surprise is out. There hasn't been any change in the Reserve Bank's commitment to get inflation down. We are not seeing any shadows of the recent turmoil in global markets or fears of a protracted recession or even a mild recession in the US. No changes to the growth forecast. Changes to the inflation forecast have been inter-quarter, and there is probably a typo there, because the governor said that the second quarter CPI forecast is 4.4. The old one was 3.8. My sense is that he was reading the next Q1 4.4 number, but we will just get it checked. If you add it as 4.4, then the average for the full year comes to 4.57, whereas the governor clearly said they are not changing the 4.5 annual forecast. But that's a minor point. The issue is they have not changed the inflation forecast, nor have they changed the growth forecast, nor have they brought down in any fashion their emphasis that they will wait for inflation to sustainably go towards the 4% mark, because that in turn will be good for growth. Most of those sentences remain unchanged. So we will have to say it's an absolutely status quo policy. A few non-monetary policy announcements seem to be very interesting, very quick check clearing. That's excellent news. That will only mean there will be even more mobility of money for the banking system, as well as the banks have to report to the credit bureaus, to the CIBILs and Experians on a fortnightly basis, which will make it even more better for the banks to take credit decisions. But the important point is it's a completely status quoist policy. So let me start with our experts who are with us. Upasna Bhardwaj, the economist from Kotak Bank, joins us. Kaushik is still with us. And we have Shobhit Mehrotra, the debt expert from HDFC, also joining us. We will have an SBI Managing Director joining us shortly. But first, Upasna, did you notice any change that I missed?
No, Latha, you correctly said it was a fairly status quo policy in terms of rates, in terms of stance. I think some nuances, but we'll have to check whether the quarterly forecast that has gone through a nearly 60 basis upward revision, that's a typo or that's real, because that otherwise looks very high. But apart from that, I would just like to highlight one point. I think, initially the governor sounded very balanced, but eventually he turned out sounding a little more hawkish, emphasizing a lot on food inflation, when actually the concerns on, monsoons and kharif sowing and overall food inflation is kind of wearing off now. So at this point, probably one of the factors why he's preferred to sound a little tilted towards hawkish is because of the way INR has been behaving. So maybe, the global volatility, the kind of pressure on rupee that we've been seeing, when many other EMs have seen actually a little bit of stability to marginal gains. In that context, maybe the governor has chosen to choose a path which is, slightly hawkish. I think I would treat this tone as being slightly hawkish.
Oh, yes. In any case, yeah, it could be a defense of the currency as well. As you point out, because that's where the turmoil is. Kanika Pasricha, the chief economist from Union Bank, is also with us. Kanika, your first takeaways?
So two things, Latha. First and foremost, I think, in the interview that you took for the governor, one phrase that he used was the silent depositor, why he doesn't want to change the rate cycle soon. I think he's tried to emphasize on financial stability in this policy a lot more. Of course, on the inflation side, the key phrase for us was when he said that food inflation pressures can't be ignored just because core is at record lows because of the spillover effects. And in fact, we would want to just connect food inflation pressures when he talked about around 65% of inflation expectations are determined by petrol, diesel, and veggie prices. So, which is why food inflation pressures can't be ignored. And it's exactly high inflation expectations that's leading to this household hunt for yield. And we see financial instability, deposit growth, especially the low-cost CASA growth is coming down. And that's what's concerning the governor, with CD ratios being high. So in our view, financial instability or financial stability concerns is what led to such a status quo policy today. Even though the last takeaway for us is, if you see the tone of the governor, yes, he was cautious, but he's trying to manage market expectations very well. It's in line with what other central banks are also doing globally, given the market turmoil, and they're calling for market overreaction, what happened earlier this week. So that was a bigger takeaway for us as well. Thanks.
What were your first thoughts on the governor's comments? Did you also think, this emphasis on the risk from food inflation spilling over to headline, did that sound a bit hawkish to you? Kaushik?
Hi, Ritu. Yeah, as I said, it was very unlikely that RBI governor will change the stance in this policy. So that is one. Second is this debate about whether we should target core inflation or headline inflation. I think he pushed back hard, saying that normal people on the street understand food inflation mostly, and therefore, headline inflation is something which is mandated, and, they'll be targeting that. So I think for the foreseeable future, for now, we probably would be concentrating on only headline inflation and not, thinking that core has come down, so RBI can consider easing rates. So he put that record very straight. And on the margin, I would say, the speech was kind of hawkish because he's still talking about inflation remaining above 4%. The best inflation forecast you have is for January-March 25, where you have inflation coming down to 4.3%. But, if you see the October-December quarter, it's 4.7. Even April-June, they're saying that inflation would be 4.4%. So that's on inflation, and growth, they're saying it will remain above 7%. Throughout for all the quarters, including April, June of 25. So on balance, RBI sounding much more hawkish. They're confident that growth will hold up. You need to keep inflation low. RBI governor is insisting that market should have patience and not hurry in forcing the central bank's hand to ease rates like advanced countries, because advanced countries have faced much bigger problems and therefore they probably need to react much more. But India is in a much better situation. And RBI is still looking for transmission to happen in the deposit side. So it doesn't look like they're in a hurry to cut rates and things will get postponed as far as expectations from RBI support is concerned.
Upasna, how do you extrapolate from these numbers? The governor, on one hand, flagging risks to continued, vegetable prices spikes, concerns from there, the spillovers, and the projections itself, fairly above 4% for the entire period, right up to the first quarter of next year. We're not seeing that, sustainable trend towards the 4% target mark. What does that mean in terms of your expectations of when we'll see that pivot?
Yeah, absolutely. I think what probably needs to be seen is that, while they've revised up their near-term forecast, their last quarter inflation has been revised down. And yet all of that is sustaining above 4%. Maybe that's one of the reasons, with growth being robust, RBI governor has chosen to err on the hawkish side. And this is something which we'll have to see how it transitions through the course of FY26. At the moment, we have a forecast of 4.2% for the full year. And that is the reason why we believe that probably December onwards is a time when the window for a possible rate easing in India will open, because that's also the time RBI will release all their 4 quarters inflation estimates for the full year of FY26. And we'll have better clarity on what their expectations are.
Okay. Well, thanks for that, Upasna. Mr. Ashwini Tewari is with us. Thank you very much, sir. The country's biggest banker is here. What's your sense, sir? There doesn't seem to have been much attention paid to the fight for deposits that we now see in the market. Any thoughts on that? What did you glean from the RBI governor? And then there were those developmental steps. You now have to report to the credit information guys on a fortnightly basis, not monthly. Do you think this will substantially improve credit quality? I can't hear. Mr. Tewari?
reduce the frequency. 1 month is...
Okay, I think, yeah, Mr. Tewari, please go ahead. You were on mute.
Okay. So I was saying that the step of reducing the frequency of reporting to the credit information agencies is a good one. In fact, we ourselves have been requesting RBI to do this because these days we find that people who take loans very, very quickly, sometimes within the month itself. So therefore, it's a good step to reduce that frequency. And there will be some systemic changes in terms of system alignment, etc., which is needed. But ultimately, it should be done. On the other part of deposits, I think the RBI has done well to flag the concern that there is a challenge where credit growth outspacing the deposits growth. And bankers are trying to substitute this regular retail growth through the short-term non-retail deposits. I think he meant, and that can create a liquidity issue. So I think this is one challenge that the entire banking industry is currently facing. And while some of the banks have raised market instruments like the infra bonds, AT1, etc., all of that is welcome. But the core of Indian banking funding always has remained deposits. Up to 90% is funded by deposits. So therefore, I think that's an important point. And launching innovative retail instruments, I think that's really important. And we all have to actually work towards that and see that where will the next growth of deposits in the retail side come from, what products or what services will attract them. I think that's a structural and system-wide issue which we have to address and which he has acknowledged.
Okay. So, Mr. Tewari, do you think that credit growth will slow down now until deposit catches up? So, you know, we are now seeing, what, 14% plus for the system, and your own deposit growth was 8% plus. So, do you think it has to come down to 11 or 12 credit growth before it picks up?
No, I don't think so. So, ours was 8.8, just to correct you. But nevertheless, in terms of the growth to fund deposit, we ourselves actually have been saying that we do have excess SLR, so we are not constrained. But the other bank and our CD ratio still is below 70, whereas some other banks have above 80, and therefore some of them have been constrained, and you would have read some announcements about loan sales, etc. My sense is that the RBI is not so much worried about the overall loan growth. It is more about segmental growth, some segments which they feel are speculative or which are higher risk, and which they have already announced some steps and have already moderated. These segments have moderated, as he acknowledged. So therefore, overall, I think loan growth is good for the economy as long as it is in the productive sectors. And the challenge for funding that, deposits, of course, and the other part is that all the instruments I talked about, they are also being raised. I don't think any bank is constrained as such, and the retail deposit rates have also been going up in response. So I don't think it has raised a situation where the loan growth will temper down before deposit catches up. This is a temporary phenomenon. We have seen these cycles before as well. I hope in the next 1 or 2 quarters, these things will start to stabilize and balance out.
Okay. All right. Sir, consequent to this policy, nothing is changing back home at SBI.
Nothing is changing. The other announcements, I think I like the announcement about digital apps, because this is one thing we have been discussing with Ministry of Home Affairs and also with the bank, because these apps, every day a new app comes up on some website, and it's very hard to identify whether it's a genuine app or not. And I think this whitelisting of apps is extremely important. The only thing is that all those apps which are not in this depository, how do we stop those? I think that work has still to be done with all the agencies.
Yes, yes. I agree with you, but the RBI has been at it that this repository has to be created and everyone has to register. Finally, check clearing has to be much faster. I guess that will also impose some costs on the banking system. Thank you very much, Mr. Tewari, for joining us with your quick thoughts this morning. Let me get to the other members on our panel. Shobhit Mehrotra, as a dealer, any changes? I think bond yields have been largely unmoved. Shobhit, can't you hear me?
Yeah, I can, Latha. Yes, you are right.
Yeah. Okay, maybe you were on mute.
Yeah, you're right. Bond yields have hardly budged. because the policy was on expected lines. The only relief from bond market perspective is that perhaps going into the policy, there were some murmurs of RBI announcing a OMO sale calendar to suck out excess liquidity. But thankfully, they have not gone as aggressively on withdrawal of accommodation, continuing the stance and announcing more, longer-term measures for removing excess liquidity. So that, in a sense, in a way, is a relief for the bond market, and therefore, perhaps the focus can now shift back to global backdrop, demand, supply, index flows, and that would determine the way yields move.
Okay, got that. Actually, I don't know. They are doing secondary market OMO sales, but he was actually positive that we have moved from deficit in June to balance in July. So perhaps there is no intent to suck out liquidity. Kaushik, your key takeaways, and now where will you pitch your stance change and rate cut timing?
So, Latha, I think the stance, in my view, has lost its relevance. It's the action of RBI that matters more, whether the short-term rates are hugging the repo rate. You remember that last October, RBI gave an effective rate hike, pushing the short-term rates to 690. And since the beginning of this year, rates have been brought down, the short-term rates through liquidity, infusion to some extent, and we are at close to repo rate now. So what matters more is where the short-term rates are hugging, the repo rate, and if RBI doesn't do explicitly almost sale, what Shobhit mentioned, they'll keep on doing it in the platform. They've already done 10,000 crore. They could continue to do more. But if overall the short-term rates are close to the repo rate, that RBI has come down. A little bit of easing has happened on the short-term rates front. So I would not, kind of try to hazard a guess when the stance will change, because, for me, it doesn't matter much. As far as rates are concerned, I think, RBI is pushing back on this idea that, you have to react based on what is happening in the global economy, because India's growth is holding up pretty strong. Inflation, if you've seen October, December, it's at 4.7% average inflation, but it's mostly due to negative base, but still it's 4.7. So if RBI has not reacted now, it's unlikely that, in this October, December quarter, RBI will do anything. So we'll probably look for something in 2025 is what my guess is. And, RBI will take its time to ensure that, growth and inflation is in a proper kind of, level at which RBI can feel comfortable to give a rate cut. If the Fed cuts 150 basis points over this cycle, you probably could have 50 to 75 basis points rate cut, but that will be, given once RBI is comfortable about the inflation trajectory. Ritu was asking, do we need to go to exactly 4% for RBI to cut rates? I don't think that is the case. RBI has to feel comfortable that the trajectory is aligned to reach 4% over a period of time. If you see January-March 26 forecast, it's quite far away, but that is at 4% forecast for RBI. So if RBI gets the confidence that you can achieve 4% over the next 2-3 quarters, then they can start easing at some point, given that monetary policy works with significant amount of lags. Doesn't look like RBI is in a hurry to do anything at this stage.
No, of course, they have to see inflation getting to 4%, which it is not as of the first quarter of next year. But Kanika, just to take that forward with you, while Kaushik doesn't want to guess when the pivot will be, between now and the next policy, we may potentially, at this point of time, have a 50 basis point cut from the US Federal Reserve. Can the Reserve Bank of India afford to, not shift the stance, not, guide the markets as to when the rate cuts will be forthcoming by then?
So thanks, Ritu. Actually, if you see 3 points. First, when Fed was hiking rates, they hiked by 550 basis points. We hiked by only 250. So even if they start with a rate cut cycle, the RBI can wait. Second, very important, stronger growth or relatively stronger growth in India vis-a-vis US and the overall global economy also gives us policy space to delay rate cut. Third and last and very important, we thought that the signaling in this policy, which Upasna and even Kaushik have talked about, is that he's been slightly more cautious on inflation, specifically food inflation. And in our view, added to that, till such time these financial stability concerns, specifically the fight for deposits among banks, is not resolved and the CD credit and deposit growth wedge gap doesn't close, which as per RBI financial stability closes via credit growth falling towards deposit growth, even during high growth phases. Till such time these gaps do not close, RBI is convinced about credit excesses moving out of the system, they would not be willing to cut rates. So our view is no rate cuts this fiscal as of now, unless and until there are global shocks or US recession fears gain momentum and Fed does dramatic rate cuts in a quick succession. Thanks.
Okay. I must give you all some more information, economists. We were, assuming or speculating whether the Q2 revision of inflation to 4.4 was a typo. It is not. Both the governor's statement and the monetary policy statement are on the RBI website, and the original 3.8 forecast for the current June, July, August has, July, August, September has been raised to 4.4. So that's a 60 basis point increase, and that takes the average for the full year to 4.57%. Now, you can see this as a bit hawkish actually. So maybe the markets will react to that. And even in Q1 of next year, which is the new forecast, it is at 4.4. That compares to 4.3 in Q4. So actually inflation is rising from Q4 of next year to Q1 of next year. I mean, Q4 of next calendar year, I meant. The point is there are two factual data forecasts from the Reserve Bank which actually point to the Reserve Bank not being in terrible hurry to cut rates. Can you quickly react to that, Upasna?
No, Latha, like we discussed in the beginning, clearly this 60 basis of an upward revision, along with his tone itself, is hawkish. So right now, he's categorically telling the markets that do not be in a hurry, do not price in any early rate cuts, come what may. Now, the point is, obviously, we have to keep into account the fact that RBI will not respond and wait for the last mile of inflation to be reaching 4%. Like Kaushik also mentioned, they will wait for the data to confirm that the disinflationary trend is underway. And that's why probably, like I said before, October, we don't expect anything really. Much clarity will be brought about how much of Fed rate cut is happening in the September policy. We believe it will still be 25 basis, though markets are nearly 50 basis. Now, all of that needs to settle down. The volatility has to settle down. That's when I see that, by December, 1 year hence, is when they will get clarity on what inflation is looking like. Their own projections are suggesting near 4%. So clearly there will be room for rate cuts, but it is obviously going to be a very shallow rate cutting cycle. For the whole tenor of the cycle that we're talking about, it will not be more than 75 basis or maybe 100 basis max, because of the real rates that they have mentioned about. So all in all, it is going to be a shallow rate easing cycle. But yes, we do assign a reasonable probability of a rate cut, rate cuts beginning from December.
Yeah, I guess the Fed will have some bearing, even if the Reserve Bank will want to stay domestic. But really, Ritu, at the end of it, we have to call it hawkish, because the inflation forecast for the current quarter, July, August, September, has been substantially revised higher, which means they don't see vegetable prices coming down anytime soon. And even the new forecast they have given for the quarter ahead, year ahead quarter, is 4.4, which is higher than the Jan-Feb-March forecast. So I would submit that both these are indications which are more hawkish than what the market was prepared for.
Well, let me toss that to Shobhit quickly, if, what you make of it and how the markets would read this revised number. 3.8 was the earlier forecast, despite that favorable base effect also kicking in July, which of course he said may reverse in the third quarter. This 4.4% kind of a CPI number. Shobhit, quick reaction.
So I don't think market will get perturbed by this kind of revision. I think market is taking more comfort from the recent vegetable price data. I think vegetable prices have corrected. Monsoon has been good. So we could be surprised with an inflation number which could be better than what RBI is projecting. And I guess as long as the full year average is closer to 4.5, I don't see too much concern which the market would have on inflation trajectory. I think it's far more important what happens in terms of growth out of US, volatility in the global markets. I think those will have far more influence on markets going forward.
Okay. Well, gentlemen and ladies, chances are that the Reserve Bank high and mighty are watching this show. So very quickly from each one of you, one question that you may want to ask the Reserve Bank Governor. Please make it quick, Kaushik.
Okay, you should ask about the neutral real rate of 1.4 to 1.9%, what they have said recently. Which side of the band are they more comfortable working with? Because depending on that, you could have either no rate cuts or you could have 50 to 75 rate cuts.
Fair point, fair point. Upasna?
I think I'll look at the liquidity side. While I agree with Kaushik that the stance doesn't really mean much of it to us, but the markets do read a lot into that. So what exactly is their stance on the excessive amount of liquidity? It's the core liquidity also, which is very high at this point.
Okay. Absolutely, absolutely. Kanika?
So Latha, while macro agree with what Kaushik and Upasna said, maybe I would want to switch something on financial stability. See, deposits, RBI has not given any policy proposal. They've left it to banks to do something innovative, while banks are fighting via raising rates.
Correct.
What is any one innovative policy proposal that RBI has in mind that bankers should implement to address this issue? Thanks.
I agree. Oh, I agree, actually. I agree. There was a proposal, actually, that long-term deposits should be allowed to be raised by banks, which are tradable. And which should be treated on par with retail deposits. This was something which came from a former member of the PJNI committee, Mr. Harshvardhan. But I don't know whether RBI has not announced any such steps. Shobhit, one question.
I think the confidence on growth, I think RBI is this year also ahead of the entire market on its GDP growth number at 7.2. Most of us are around 6.5 to 7. So, the confidence on that.
Yeah, especially if the non-farm payroll turns out to be as bad in August as it was in July. Fair point. Ritu, what would you ask?
I think I'd want to ask a lot about those 4 pain points he highlighted, specifically about, unsecured pockets still seeing some high growth, and also on that top-up loan concern where he's really seeing it, because, we've seen some of the NBFCs recently announce those. So, those banking-related concerns, I think we'd want to hear more from the governor on.
Oh, you have spoken like a top-notch banking reporter. Certainly, we'll try and see how much we can squeeze in. We're all rationed just one question, but perhaps there will be others who will raise your concerns with the Reserve Bank Governor. But for the moment, we wind up on this special monetary policy coverage with the note that the indication of forecast seems to be that the Reserve Bank, if anything, is a notch more cautious. But there is no sign of any dovishness. At least the shadows of the US non-farm payrolls are not yet being cast on the Reserve Bank's policy. We will know if there is something different in the press conference, which we will bring to you live at 12 noon. Thank you very much for watching this special broadcast.